Welcome to Europe Hotel School, London. Today, we'll explore the essential financial statements crucial for the hospitality industry, providing a foundational understanding for both students and professionals. These statements are vital tools for assessing financial health and making informed decisions. We'll cover the overview of financial statements, specifically delving into the income statement, the balance sheet, and the cash flow statement. Each of these provides a unique perspective on a business's financial performance and position, offering a comprehensive view. Financial statements are often referred to as the language of finance. These critical reports help executives make strategic business decisions within the highly competitive food and beverage sector, guiding everything from pricing to expansion plans. The income statement, also widely known as the profit and loss statement, presents a clear picture of revenue generated alongside all associated costs, ultimately culminating in the profit results for a designated time period, typically a quarter or a year. Key components include the total earnings derived from food and beverage sales and various service deliveries, which collectively constitute the revenue or sales figures. This represents the top line of the income statement, showing the total money brought in by the business. Direct ingredient expenses for menu item production, such as the cost of raw materials like fresh produce, meats, and spices, represent the cost of goods sold, or COGS. This is a crucial metric for understanding the direct costs associated with generating revenue. The calculation of gross profit is a fundamental step, depending on subtracting the cost of goods sold from the total revenue. This figure indicates the profitability of a business before accounting for operating expenses, highlighting efficiency in production. Business expenses encompass a wide range of costs, including personnel costs like salaries and wages, utility expenses such as electricity and water, maintenance fees for equipment and facilities, marketing expenses to attract customers, and other organizational overheads like rent and insurance. Net profit requires a multi-step calculation. First, subtracting all operating expenses from the gross profit, and then either adding or subtracting taxes to the equation, depending on the tax implications. This final figure represents the true profitability of the business after all costs are considered. Consider a practical example. A hotel restaurant's revenue reaches an impressive $100,000 for a specific period. During the same period, its cost of goods sold is $30,000, and its total operating expenses amount to $50,000. These figures provide a clear starting point for our calculations. To calculate the gross profit, you would take the revenue of $100,000 and subtract the COGS of $30,000, which then amounts to $70,000. This $70,000 represents the profit made from sales before considering other operational costs. The calculation of net profit then requires taking that $70,000 gross profit and subtracting the $50,000 in operating expenses, ultimately resulting in a $20,000 net profit. This $20,000 is the final profit the restaurant has earned after all direct and operating costs. Next, we turn our attention to the balance sheet, which displays an operation's current financial status. Crucially, it presents data at a specific moment in time, offering a snapshot of what a company owns and owes. Unlike the income statement, which covers a period, assets represent the valuable resources the business owns, which can be tangible or intangible. These include readily available cash, inventory of food and supplies, and essential equipment like kitchen appliances and furniture. Assets are what the business uses to generate revenue. Conversely, the company owes debts to others through various obligations, such as bank loans and outstanding payables to suppliers, which collectively form its liabilities. These are financial obligations that the business must settle in the future. Equity represents the owner's business ownership value, which is a residual claim on assets after liabilities are paid. It is precisely calculated as total assets minus total liabilities, reflecting the net worth of the business from the owner's perspective. For instance, imagine a company that holds assets worth a total of $200,000. This comprehensive figure includes $50,000 in cash, $100,000 invested in equipment, and $50,000 held in inventory. These are all resources the company controls. Simultaneously, the total liabilities for this company amount to $80,000. This sum is composed of $50,000 in outstanding loans and an additional $30,000 in outstanding payables to its vendors and suppliers. These are the company's financial obligations. Based on these figures, by subtracting the $80,000 in liabilities from the $200,000 in assets, the total equity amount reaches $120,000. This calculation clearly demonstrates the owner's stake in the business. Finally, the cash flow statement tracks all financial transactions, providing insights into how cash is generated and used. It categorizes these movements into three main areas: operational activities, investment activities, and financing activities, offering a dynamic view of cash. The Operating Activities section specifically calculates the cash flow derived from the core business operations, such as cash received from product sales, offset against cash paid for operational expenses like salaries and utilities. This shows the cash generated from day-to-day business. The Investment Activities section demonstrates the cash expenses related to acquiring long-term assets, such as buying new equipment for the kitchen, or enhancing existing facilities like renovating dining areas. These are investments made for future growth and efficiency. Conversely, the Financing Activities section details how the organization receives cash from external sources. This includes funds obtained from both loan funding, such as bank loans, and investor funding, like capital injections from shareholders. It shows how the business is funded. The success of profitable operations depends heavily on maintaining sufficient cash flow. This ensures the timely payment of immediate expenses, including crucial payroll for employees and supplier costs for ingredients and services, preventing liquidity issues and ensuring smooth operations. Understanding these three fundamental financial statements, the income statement, balance sheet, and cash flow statement, is absolutely vital for navigating the complexities of the hospitality industry. Mastering them empowers you to make strategic decisions and ensure long-term success. Thank you for joining us at Europe Hotel School, London.